Thank you for attending to the Seewing Yee from the Real Estate Network. And my special guest is Mr. Richard.advani from Supreme Lending, an investment loan agent. And quickly, we're gonna go over in real time today. Today is Thursday, March 24th, is it? Yeah, March 24th. So let's talk about everybody already want to know what's going on with the interest rate as a relative to the real estate investing, what have you. So without further ado, Richard, share with us what's going on with the interest rate, the rising interest rate, how the Fed is doing things, and what is your crystal ball for the rest of this year, and how is it going to impact the primary home buyers, the interest rate, how it's going to impact real estate investors. With that in mind, quickly, we only have 5 minutes. Go ahead, take it away.
Yeah, absolutely. So interest rates obviously continue to rise from the start of the year. What most people don't realize is fixed mortgage rates are actually based on the 10-year Treasury bond, not the Fed rate, although the Fed rate does influence everything. The 10-year Treasury bond has almost doubled since the start of the year. And as a lot of us know, interest rates have gone up, man, almost 1.5% right now from the bottom that we've seen in the last 2 or 3 years. Now, it's important to note that they are still historically low. However, interest rates for primary homes now are in the mid 4s. And, keep in mind, primary home rates were in the high 2s, not even 4 or 5 months ago. And investor rates obviously have moved up pretty sharply as well. Typically your investor rates are going to be in the high 4s to low to mid 5% range for Fannie Mae programs, which I know sounds very high. However, once again, historically, it is still near the bottom of what interest rates have been. It's also important, and I know, I talk about this a lot, but it's also important to factor in inflation. Rates may seem high, but inflation is double of what rates are. So, that's still a good long-term wealth builder as it relates to rental real estate. Now, throughout the end of the year, it's tough to say. I mean, with how sharp the 10-year Treasury bond increased the first 60 days of this year, we thought we saw a lot of the increase that was going to happen for at least the next quarter or two. But it's continued to rise, and, there's so many factors that influence rates, internal as well as geopolitical, like what's happening in Ukraine right now. So I wish I could give more of an indication. I'd say, prepare for rates to be up to 1/4% to 0.5% higher than today through the end of the year, but hopefully not much, beyond that. Now, the good news is, I was just reading an article this morning stating that nationally rents are up 17% from last year. And keep in mind, rents take a year to catch up on rates going up. So we will continue to see rents rise through the end of this year, which will make up for some of that increase in interest rates as it relates to cash flow on these properties. It may take a little, couple more months, 3 to 4 more months for those rents to catch up. Keep in mind, most leases are written at 1-year increments, right? So you're not going to see an increase till that 1-year lease expires, but they're starting to expire. And with that, once again, nationally, we're seeing rent increases. So overall, rates are still pretty dang good. Get used to paying 1 point to 2 points on investor loans now. I know all of us, for the longest time, for probably 5, 6, 7, 8 years, points were they vanished. They weren't prevalent. And now it's almost needed to get that right attractive interest rate. But yeah, now still as good a time as any. Once again, inflation's going up. 30-year fixed is the best hedge against inflation you can get. It's still well below inflation. And of course, rents continue to go up as well. So, but yeah, I mean, if you have been sitting on the fence till now, big mistake, obviously, right? We always talk about that regardless of the rate market is, waiting to invest in real estate is a big mistake. And even more so now for, people that were on the fence 4 months ago. Now, the question is, are you going to be further on the fence since rates have gone up, or are you going to get off the fence? And, there's always going to be reasons that you can come up with to convince yourself that it's not a good time to invest in anything. But once again, Ray Dalio, Warren Buffett, they all say, don't try to time the market because you will get burned. But let's fingers crossed that rate's going to level out from here, though, for all of us.
Yep, Richard, well said. My takeaway as we conclude this 1 minute longer, my takeaway from today's conversation is that for primary home buyers, that may disqualify some primary home buyers from entering the market, but the demand is still going to be strong. So the market is going to stay hot. The Zillow just predicted there will be a 17% appreciation for houses for the year 2022. So this rising interest rate, a lot of people have FOMO, fear of missing out. They want to, in this next few months during the spring housing market, we expect to see some a lot of people try to, as a last gap, try to buy a home before the rates continue to go up. So I kind of expect to see a bidding war almost everywhere in the country, multiple offers, but we still have record low inventory, which is in very, very continued high demand. That's for the primary home buyers market. And for investors, like you just said, even with the increase of interest rate for investment loans, with the skyrocketing of rent will offset your higher mortgage payment. Besides, as an investor, you're only buying properties that are only worth anywhere from $50,000 to $350,000. It's not like your payment's going to go up that much just because an investor is paying 4.5 to 5.5% interest rate on the 30-year fixed mortgages to buy cash flow properties. So with that said, thank you so much for listening, and we will update you on a weekly basis on the mortgage rates update and a recent market update with Richard.advani from Supreme Lending. Thank you for attending, Richard. Thank you for your time. Appreciate it. Thank you for everybody listening. Have a nice day. Bye-bye.